Today, an emergency liquidity backstop, the Federal Reserve standing repo, was tapped yet again. If you're wondering what that is and what that means, in this video, we'll break down what the SRF is, why it's being used right now, and what it tells us about the bigger picture of money market stress. So, the standing repo facility, the SRF, an emergency liquidity backstop, it is standing because it was permanently established back in 2021 to try to prevent another repeat of the repo rate crisis that we saw in September of 2019, where repo rates on an intraday basis went 9 percentage points above and beyond the Fed funds rate. Can you imagine? So, how did we get here? Well, just as we were going into that repo rate crisis of September 2019, the Fed has been engaged in quantitative tightening, which is the exact opposite of quantitative easing. Now, quantitative easing, the Fed prints bank reserves out of thin air and then buys, with those freshly printed bank reserves, buys assets from the banks. So now the banks have more cash, more liquidity, and the Fed has an asset to put on its balance sheet. So that is the green line. And of course, bank reserves in red. Well, how did we get here? Just as we were engaged in quantitative tightening, we have been engaged in quantitative tightening going back to April of 2022. We can see the Fed balance sheet has been declining. Well, this has had a negative impact on bank reserves. Again, just as QE creates bank reserves, quantitative tightening destroys bank reserves, which have gone from 4.2 trillion down to just 2.8 trillion, taking a sharp leg lower over the past 2 months. Well, not only that, but the reverse repo facility, think of it as a buffer or shock absorber where excess dollars that were printed above and beyond what the banking system, what the economy actually needed, were stored in a facility on an overnight basis. Now, at the peak here, the reverse repo was about 2.5 trillion. We can see is down, basically empty. And what happened was a couple months ago, the Treasury General account started to get rebuilt. The Treasury announced, hey, we want a buffer in our checking account, just as normal people want a buffer in their checking account. And we are going to build our TGA up from about 320 billion all the way up to 850 billion. Now, they overshot in part due to the government shutdown. But again, this is when we started flagging this liquidity crisis, because it was pretty clear that this was going to have a deleterious impact on bank reserves. Because again, the reverse repo at the time was only about $90 billion. They were talking about a rebuild of 500 billion. Well, if it can't come from the reverse repo, that shock absorber, it's got to come from bank reserves. And sure enough, that is exactly what we've seen. We have seen bank reserves go from about 3.4 trillion at the time of the announcement down to just 2.8 trillion dollars. Now, what is the standing repo facility? What is repo at all? So here we can see how this works. So the way that this works, it's an overnight repurchase agreement where the Federal Reserve buys an eligible security. Now, this can be a mortgage-backed security. This can be a U.S. Treasury, and agrees to sell it back the following business day. So effectively, what's happening is the Fed is printing money out of thin air, and then in return for the freshly printed dollars, the financial institution gets freshly printed dollars, and in return, the Fed gets securities. And then again, the next day, that is a reverse. So there's the standing repo, which is injecting bank reserves, injecting liquidity, and then there is the reverse repo, which is the exact opposite. That is removing liquidity. Again, that was that shock absorber that we were looking at. So when a counterparty, which is usually a bank, an eligible bank, or a primary dealer, if you've been watching the U.S. Treasury auction videos, you'll recall that term, primary dealer, when they borrow from the SRF, the New York Fed credits their account. They have a account, bank reserve account at the Fed, and they're credited with the exact amount of that repo loan. Think of it as an overnight, very short-term loan. Now, there is a haircut, meaning that if I supply $100 of U.S. Treasuries, I might only get $98 from the Fed. So there is a bit of a haircut. It's all electronic. The Fed is printing these bank reserves electronically. But again, remember that it is reversing the next day. The Fed then takes the treasuries, the mortgage backed securities, they put those onto its balance sheet under assets. So it is an asset for the Fed, again, just for that one day, but it is an asset for the Fed, and the reserves that are created are liability for the Fed. Now, eligible counterparties include those primary dealers that we always talk about in the US Treasury auctions and select depository institutions. Now, that's a fancy term for a bank, but you have to meet certain criteria in order to get access to this standing repo facility. And they've been trying to expand it over time to include more banks. And as we can see, that has been a very necessary effort because, as we can see, repo rates have been indicating that there's severe stress in the liquidity in the banking system liquidity. So each counterparty can submit up to 2 propositions per security type. So again, there's mortgage backed, there's US Treasuries, and there's a minimum size of 1 million. And then the bids go in $1 million increments. So if we go over here to the repo operations, you can see that down here, there's a total limit of $500 billion. Now, operations occur twice per day. What we're looking at today is the morning operation for today. We can see it was tapped for $2.5 billion. Again, we can see maturity date. That is when the loan, the very short-term loan, comes due. And then we can see the operational limit, $500 billion. Settlement occurs very, very quickly. So this is all processed through what is called the Fed Trade Plus system. And as soon as the award is given, basically at the speed of light, the cash is credited to the account. So it's all happening electronically, and it's all happening very, very quickly. And then, of course, the Fed publishes the report. We can see, again, there's a morning operation and an afternoon operation. And this has not really been used, as we can see from this standing repo chart. Going back, in this case, to November 2024, we can zoom back even further and show that it is very, very it has been very, very rare that this facility has been used. Now, we did see a spike at the end of Q2 for 2025, but going all the way back to 2023, all the way back to the end of 2022, we can see this facility was not used. Why was it not being used? Well, because we were in abundant liquidity. Again, that shock absorber was full of cash. So there was a huge amount of buffer that was kind of built into the system. Again, that is what the white line is showing. That is the reverse repo, which is, again, the facility for excess liquidity minus the amount that is being tapped in the standing repo. Now, this has just started to go negative over the past couple weeks. Here, by the way, we can see the repo rate crisis, and we can see the inverse correlation with bank reserves. So again, you can think of the white line being above zero as being an abundant liquidity regime. Anything below the pink line, anything below zero, means that there is more money being tapped from this emergency liquidity backstop than there is in the shock absorber. Hopefully that makes sense. As we can see with the green line, bank reserves, this is pretty correlated with the SOFR spreads that we have been tracking on this channel for the past couple months or so. It has become quite the popular topic. I do want to point out something here that is, I think, very, very important. So when we're talking about SOFR, when we look at SOFR in TradingView, we are talking about median, the volume-weighted median interest rate for SOFR. And here we can see, by the way, that median SOFR interest rate minus the discount window rate. So I've been tracking it in Excel. And of course, we had 6 consecutive days where SOFR was above the discount window rate. But again, this is the median SOFR rate. What I wanted to show was I've also been tracking the 75th percentile, which again, they provide a distribution for SOFR. Here we can see that straight from the Fed's own website. And so I've been tracking the 75th percentile as well. And what we see there is a notably different picture than what we see with the median, which is that 25% of the borrowing in the $3.1 trillion large SOFR market, 25% of it over the past 4 days has been occurring above the discount window rate. Now, the discount window rate is the same thing, by the way, as the standing repo rate. That is the upper bound that the Fed tries to set in terms of the cost of overnight capital. Now, for the Fed funds rate, which is a similar dynamic, very short term loan, but it's interbank and it's unsecured. That range, the upper bound, is IORB, which is the green line. But for SOFR, which is much larger, 3.1 trillion is financed in the SOFR market every day. The range there is the upper bound is the discount window rate and the standing repo rate. So again, to use this operation, there is an interest rate assessed. Well, the interest rate, as we can see here, 4%. Well, if we go back to our overnight money market chart, we can see 4% right now is the upper bound. Now, SOFR just the median SOFR interest rate just tapped 4% on Thursday. However, for Friday, we just got data and it did come in a bit, indicating that maybe liquidity did start to ease a small amount. I do want to point to, of course, the timeline, which I think speaks for itself, which is the Fed, everyone at the Fed that matters, the chairman of the Fed, Jerome Powell, and both the former SOMA manager and the current SOMA manager, both of them, all three of them, have come out and tried to warn the public or warn the system, the financial system or market participants about the liquidity shortage. Jerome Powell, of course, gave very unusual comments. Then the next day comes out, the Fed released a report showing, hey, by the way, the Cayman Islands hold 1.8 trillion in U.S. Treasuries. They've been purchasing about half of all U.S. Treasury debt over the past 3 years. And the reason they're purchasing so much is because they're in the highly levered basis trade. They remind everyone in that report that's financed via the repo market. Then, a couple weeks later, Lori Logan, the former SOMA manager, now SOMA you can think of as the Fed's balance sheet, the manager of that balance sheet, said that asset purchases must return if repo rates don't soften. Then, about 2 weeks later, Perley, the current SOMA manager, came out and said reserves are no longer abundant. Then, that same day, the New York Fed held an impromptu, hastily arranged meeting with primary dealers on use of the SRF, the standing repo facility that we have been talking about so much. By the way, here are SOFR spreads, and I've overlaid any time the SRF was used over $1 billion. And we can see, hopefully the picture here is abundantly clear, which is not only have SOFR spreads, not only have those interest rates been headed screaming higher, not only that, but there's an increasingly frequent and increasingly large usage of this standing repo facility. Now, this is the goal of the standing repo is to provide emergency liquidity. But again, I will point out that 25% over the past couple days, well, arguably for a 2-week stretch period of time back here when rates were really, even the volume weighted median was above the upper bound. But even over the past 4 days, 25% of SOFR borrowing has been above that Fed upper bound. Now, there is a stigma associated with this SRF facility. The parties that use the SRF, now we saw the results, but the actual banks or the financial institutions that go and tap this SRF, though the list of those names is not published for 2 years, but there's a significant amount of stigma with using this kind of emergency liquidity backstop, which is why there's some hesitancy and why some, or 25% of SOFR borrowing is happening above at a more expensive interest rate than the Fed's upper bound, which is, of course, 4%. So there is not only a tightening of liquidity in the unsecured interbank market, as we can see from the purple line. That is the Fed funds, which is up near the upper bound of the range. In fact, it looks like it ticked even 1 basis point higher today and is now just 1 basis point below the range. Not only is the unsecured market starting to get tightening liquidity, again, elevated Fed funds relative to the Fed's floor, the reverse repo, not only that, but SOFR much larger $3.1 trillion market, that those interest rates have been quite elevated, as we can see from the green line here and from here. Now, remember, the answer to this is an injection of liquidity, which is exactly what they did in 2019 with the repo rate crisis. We can see bank reserves went from about 1.4 trillion up to about 1.6, 1.7 trillion. And then, of course, we know what they did. They went all the way up to 3.2 trillion with that event that happened a couple months later. And of course, the Fed's balance sheet grew in size because, again, the way those bank reserves get injected into the system is by buying financial assets from the bank. So anyways, hopefully that was helpful, and I'll catch you in the next one.